Hello and good evening, everyone. My name is Abhijit, and welcome to a new episode of Investing Fool. As discussed on yesterday's video, in today's short video, we will discuss the rebalancing at the end of September for our Nifty Top 10 portfolio. So we'll look at which stocks were kicked out of the portfolio and which stocks made fresh entries to the portfolio. What are the changes? What has been the performance? What are the trends and some other related items. For those of you who do not have any context on this particular portfolio, we started this back in March. So it has been 7 months for this portfolio now, and this is just comprised of the top 10 uh, uh, ranked stocks out of the Nifty 50 universe in terms of momentum. So the momentum indicator that we use for these stocks is the same as that we use on our core portfolio, which is average Sharp of 3 months, 6 months, 9 months, and 12 months. The only caveat is that the exit here is very tight in the sense that anything that gets out of the top 10 portfolio is basically taken out of the portfolio, right? So in that sense, the exit criteria for this is not relaxed as we have in our core portfolio. It is pretty tight. But yeah, so that's the basic context of this portfolio, and you can check out the other videos on our portfolio also, the previous videos that we have made on this specific Nifty Top 10 portfolio. This was started as an experiment because it is relatively very difficult to beat like an index composed of mega caps like the Nifty 50 based on a single factor, but we'll see if this works out. Till now, in this kind of a bull run, it has worked out nicely, but let's see if it's going to continue that performance in the future. uh, okay, so before we get started, again the familiar disclaimer that none of the stocks are recommendations, so please consult your financial advisor before making any investments. Let's look at the September rebalancing trends. So Nifty 50 as a whole, we are close to 25,800. We have lost some ground because we were comfortably above 26k, and then we are sort of like consolidating, taking a breather, kind of a healthy stop before probably the next move. There are no headwinds apparent as such, and like although there are concerns about a lot of international foreign investors money like going to emerging markets after the rate cuts, and which has been primarily moving to China over the past couple of weeks. I'm not sure if that is going to be a continuation in general. So India should still stand to gain from the overall emerging market kitty, the inflows due to the rate cuts, and our market should profit from that, right? Anyway, but that is where Nifty 50 as an index stands currently. And in terms of our Nifty Top 10 portfolio, the absolute return till now, which is from the inception of the portfolio over the last 7 months, the absolute return has been 21.7% versus 15.5% for Nifty 50. And while we are all discussing these numbers, we should have things in context, but because what I'm saying is basically that Nifty has given 15.5% returns in the last 7 months, right? And in less than a year it has like given 30% returns or something. These returns are not normal for Nifty 50, which on average gives somewhere between like 12 to 13% annually, and so these are good times. These good times may not last forever. We should always have that, and we should temper our expectations, especially in such a large cap indices, right? But yeah, coming to the rebalancing part, so what has changed in the portfolio? So there are 4 entries this time and 4 exits, of course. We will discuss those stocks. One big thing is Trent. So Trent recently entered Nifty 50, as we had discussed in the previous video. Trent and Bharat Electronics both entered Nifty 50, and LTI Mindtree and Davis Labs got kicked out of Nifty 50. And as soon as Trent entered Nifty 50, the momentum was so strong for this stock. We have been holding this stock in our core portfolio for some time. It will be like I guess in 3 years it will be close. Sorry, in 3 months it will be close to 1 year that we have been holding Trent. But in the moment is it entered Nifty 50, it also entered the Nifty Top 10 portfolio, our Nifty Top 10 portfolio within the next rebalancing, because the momentum score for it is so high, right? The returns have been like phenomenal, astronomical, and because of that it is right at the top of the stock rankings within Nifty 50. But will that performance continue after Nifty, after the entry into Nifty 50? We'll have to wait and watch. There have been like discussions around stocks which have shown a lot of promise. They have gotten into Nifty 50, and a lot of this is already priced in into the stock. जितना चाहिए होता है उतना भी प्राइस इन हो जाता है, उससे ज़्यादा भी हो जाता है, राइट. सो द मार्केट काइंड ऑफ ओवर कॉम्पेंसेट्स फॉर दिस, फॉर वेलकमिंग स्टॉक्स इनटू निफ्टी 50, and before they enter they have been taken to astronomical heights. Like Trent is currently now like some might feel it is fairly overvalued, right. As momentum investors, that's not our call, but I'm just putting things in context that prices are driven up so much in expectations of stocks getting into Nifty 50 and all those passive flows, inflows coming into those stocks, that of sometimes it happens that stocks lose their sheen after entering Nifty 50 and they start kind of underperforming. And if you look at something like a Divis Labs, right? Divis Labs entered Nifty 50, I think around the end of 2022 or sometime around that, and it had a huge run before that, right? And after that, like the performance was such that Divis Labs actually got kicked out this time in this reaching of Nifty 50 while Trent and BEL were entering, right? So and now Divis Lab is still showing good momentum for the past few months, right? So it may again enter Nifty 50 at a later date if the good performance continues, but such is the history, and stocks can often like the performance trend can often reverse after such changes and getting included in these big indices. So we'll see how Trend performs continue going forward. Now it is part of both of our portfolios, top 10 portfolio as well as the core portfolio. Anyway, let's take a look at the exits. So we made 4 exits: Tata Motors, Infosys, HCL Tech, and SBI Life. The problem with 3 of these is that they only spent a month in the portfolio, which means they came in the beginning of September and they're going away in the beginning of October. And the entire IT, so these two were like are IT large caps, and IT, the index has seen a fair bit of slowing of momentum. I wouldn't say that momentum is lost or anything. In the long term, the trajectory still looks very fine. So we'll look at the index also, but in terms of the exit metrics, as we are seeing here, just give me 1 second. Yeah, so winners are 40% with an average gain of 11.2%. Losers comprise 60% of the exits with an average loss of minus 3.9%. Average holding period, you can see Tata Motors is the only one which stayed for quite some time, almost 3 months. Average holding period in terms of days is now 73 days. So this has been boosted by Tata Motors spending so long a time in the portfolio. Let's look at the entries one. So these are the 4 exits. If we look at the entries, we have Trent, we have Shriram Finance, Britannia, and NTPC. So during prior to these rate cuts, there was a lot of noise on banking stocks and NBFCs and other BFSI stocks doing well. Probably Shriram getting included is one indication of that, but the other private banks, like they haven't, although they have been performing well in recent times. If we look back 1 year, because we are taking multiple look back periods and kind of consolidating the momentum score across those periods, right? So 3 months, 6 months, 9 months, 12 months. When we look at the entire window, these stocks may not probably have not done as well as something like a Shriram Finance, right? So of the 4 stocks entering, Britannia is consumption. NTPC we had in our portfolio, it had exited the portfolio with a gain, and we are taking NTPC back. So it's kind of a second run of NTPC in the portfolio. And by the way, in that same vein, Tata Motors is having a second exit from this portfolio. So we have already held Tata Motors twice within these 7 months. And if we look at the exits, there's a fair bit of churn, of course, and that is because of the tight exit criteria, right? So anything that exceeds 10 is basically kicked out of the portfolio. I know that it's a very tight criteria, but if we relax it to, let's say, 15, so 15 becomes 30% of the Nifty 50 index, right? 15 stocks is like 30% of Nifty 50. and that's why I have been reticent to do that. So that's why I've kept the exit rate as very tight. I want stocks which have like consistent momentum to get identified fast and to stay in the portfolio, right? And even a mild weakening signal from a stock is taken as cue to take that stock out of the portfolio, so that we always try to stick to the stocks with the most strength and promise, right? Okay, going back here. So if we look at our like gains share here, auto stocks are still driving a majority of the gains. So we have M&M at 45%, Bajaj Auto at 50%, Bharti Airtel is Telecom 40%, Hero Motor is 27%. So these three, Hero Motor, Bajaj Auto and M&M, have driven a majority of the gains of this portfolio. And Bajaj Auto and Hero Motor have been there since the beginning of this portfolio. They have never left the portfolio, right? We'll look at all the charts. So let's actually take a look at that. And the last point that I wanted to discuss is whipsaws, but we will get a better sense when we look at the charts. Okay, so as I said, out of the 4 exits that we are making, these are the 4 stocks. Tata Motors stayed for 92 days, minus 3.4%. Infosys 29 days, minus 3%. HCL Tech 29 days, plus 0.9%, and SBI Life 29 days, minus 2.3%. All of them got kicked out because they were out of the top 10 momentum ranks in the Nifty 50 universe. Now, the green arrows and the red dots kind of show the entries and exits in these stocks. So you can see that like when we bought these stocks, right, whether you see for Infosys, for HCL Tech, for SBI Life, the stocks had a huge run before that, right, and that's when the system gave a cue to get into these stocks. The moment we get in, the market as a whole didn't move, probably didn't move that much, but IT index also slightly started consolidating, right? So the IT index, if we look at the performance, so I'm in the core portfolio sheet, and I'm in the sector and other indices sheets, right? So if we take a look at Nifty IT, what is the 3-month change here? You can see the 3-month change is 12.5%, right? Very good. Only below pharma, which is at 15.4%. So 3-month change looks very healthy for IT and pharma. Okay, it's below FMCG and consumption also. So IT, consumption, pharma, right? The defensive sectors of the market, they were at play. It was very good. So 3-month change looks very good. If we cut back to 1 month, in 1 month IT, the index has given minus 1%, right? So that's not a very pretty picture, and that is why many of the stocks have not really done anything. So after they got into the portfolio, they kind of kept hovering around the same mark, huge red candle here, and again it recovered, but it hasn't been going anywhere, right? And when that happens, usually the rank declines, and once the rank declines, then you go out of the portfolio. So fairly limited duration to gauge a stock, but that always happens. It may also happen that in the next month they again run up a bit more, right, and they come back into the portfolio. That we always have that risk of whipsaws. So while the exit criteria is tight and the churn increases because of that reason, but one other consideration is that we want stocks with consistent strong momentum to stay, because if the stocks continue to show such momentum, like relatively compared to other stocks, then there is no reason for them to get out of the portfolio, right? So stocks, so like for example, let's say M&M, right? M&M came in May, so 2 months after the portfolio got created, right? And from then, like it has just continued its performance, right? And it has continued to stay in the portfolio. Okay, and now here a curious case is of Tata Motors, right? These 3 we anyway entered recently and we exited within a month, but Tata Motors, look at that. This Tata Motors, first time we entered in the beginning of March. Okay, the stock showed amazing promise here, a nice trajectory here. We entered here, okay, then it went up and then it came crashing down. It again like retested that resistance level quite a bit, and then it just kind of kept hovering in a band, right? and after that, like, it started sliding from this range as well, and this is where we exited. Now after we exited, again it went up a little bit, then came down, then went up. It's basically kept hovering, and for some reason, because of how relative ranking works, other stocks may have performed even worse compared to Tata Motors. And Tata Motors, again, because of the sustained run, right? Because when you are standing at this point and looking back, this return is still counting, right? You're looking back at the whole 1 year. You are not just looking back at the last 2 months or 3 months. So anyway, the ranking again improved, and we again took an exit here, not far from where we, again took an entry here. This entry was not far from where we took the entry, and even this exit was not far from where we took that entry, right? So anyway, we entered again. It did a fair bit of up move. Then here it like went up like crazy, then went down like crazy, then again went up, went down, again started hovering around the same mark, and we are kind of having to exit here. But if you look at the overall chart, right, so basically we have gotten 2 false entries, and then we have taken 2 exits because of that. Time waste hua, kuch haath mein nahi aaya, right? But if we look at the overall trend from March, the stock has not really done anything. It has basically just stayed where it was, and that is a kind of momentum, that is a sign of momentum kind of slowing down, or at least not doing as well as we hoped it would. Okay, now let's if we look at the IT index, which we were just talking about. So while individual stocks may have gotten out of the portfolio because they couldn't continue their outperformance, index as a whole, this is the weekly chart of IT index over 5 years. So if you look at the like the larger picture, right, in terms of 5 years, this high that was made after COVID was a very like crucial resistance for the IT index to cross. And you can see here, once it tried touching that index, it started to like cross, but then it quickly fell down, right? Again it like raised itself up, and it started moving again, and this time it successfully crossed it, and now it looks to be in a fairly like bullish trend long term to me. The like 20 DMA is also over the 50 DMA, over the 200 DMA. So all like the stars look well aligned for IT to kind of make further up moves, albeit like with little bits and pieces of consolidation will always be there. These could extend to months also, but I like do not see a very heavy pull down or anything, at least on the index part. So this, once it has crossed something like this, you can see 2020 March, this is the COVID fall, and then you can see the meteoric rise that IT had after COVID. And once a sector has this kind of a rally, because of multiple factors, like liquidity was there, the promise that IT showed at that point when everyone was confined to a virtual environment was probably overcompensated by market participants. Lots of overhiring was also done by these companies, and then like when the markets turned, when liquidity crunch started, then a lot of layoffs was done by the same company. So all these keeps happening, like market cycles and interest rate cycles, and similarly sectors have their own cycles, right? So IT had a huge rally after COVID, and because it had such a huge rally, the next 2 years it kind of did nothing, right? And once it did nothing again, so once you have a very good time, then that creates the basis for having some bad time. Once you have a bad time for like an extended duration, that creates the base for again the next good time, right? So the bad and good times will keep coming one after the other, and the amount of resting period of course depends, right? Okay, so that's about IT. Now, what stocks are entering the portfolio? So as we discussed, these are the 5 stocks that are entering. Trent with a 1-year return of 271%. Just imagine a company in Nifty Next 50, currently a part of Nifty 50, has given 271% return in the last 1 year. Shriram Finance 1 year 86%, Britannia 1 year 44%, and NTPC 1 year 83%. RSIs of these are usually in the same range, so 66 for both Shriram and Trent, and NTPC is at 68. That seems to be kind of the holy range for Nifty 50 companies. Britannia, which is consumption, so FMCG I think is kind of doing pretty well for some time. Britannia has currently an RSI of 80. Okay, and it has a huge up move here. So there could be some very short term consolidation as well in Britannia. I see like a huge red candles at the end of this chart. Now the interesting case here again is NTPC. So NTPC we entered in the beginning of March, around here, had a little bit of fall, but the overall trend was going up, not very fast, but going up, right? This huge red candle here is the one that you see here is the June 4 election debacle red candle. Again, it went up. We exited somewhere around here. Again, that may not entirely be due to the performance of NTPC per se, but because of the outperformance of other stocks that were showing promise. So I always say that when a stock is getting kicked out of a momentum portfolio, it may not be because of the stock itself performing bad in absolute terms, but in relative terms compared to other participants, it may be the momentum may be slowing a bit. So we exited NTPC here. It again went up, down, then again it started going up, and again here we are entering NTPC again. So let's see how the second run goes for NTPC, and that is because we have this trade-off of how agile or how receptive your strategy is to the changes in stock momentum versus how many transactions you are kind of doing, right? So there is a lot of churn here because our criteria are a little tight, but if the stock keeps performing, if the performance just remains consistent, and then there is no reason why a stock cannot come back again to the portfolio, and hopefully it remains for a long time this time in this portfolio as well. So that's all about the Nifty top 10 portfolio. If you have any questions, let me know in the comments below. Look forward to your valuable comments, and if you like the video, then please hit the like button. If you haven't subscribed, then please subscribe to this channel. I'll see you in the next video. Till then, have a good day. Bye bye.